Hi everyone, and welcome to this week's Symax Fintech Market Insights. As usual, it's broken into 4 pieces. As usual, we start with our disclaimer. So trading involves the potential risk of loss of capital. It's not suitable for everyone, although hopefully it is for you. When it comes to leverage, just be careful because you can lose substantially more than that initial investment. Everything we include in here is just purely for educational purposes. We're not trying to provide you with advice, we're just trying to help you prepare, understand the markets better, to help you make better decisions. But of course, if you are looking to invest or trade, that has to be your decision. And before you make that, you should consider your financial situation, your level of experience, and your risk appetite. And of course, on your risk capital, you're prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before risking your capital. Okay, so interesting week last week, so let's have a look at what happened. So yeah, Israel entered Gaza as many was expecting, but it was very controlled and systematic so far. And I suppose, there's considerable political efforts going on in the background by Biden and other leaders to try and avoid any major escalation, keeping the other Middle East countries out as much as possible. Some of the militants there, it's unlikely to keep them out, but for, the countries themselves, that's important because that could really have a major disruption to supplies in many areas. And of course the market reaction was minimal because of that, and that allowed traders to focus on the data that was coming out, the central bank rate decisions and the employment data that was being released. So if we go through some of the data, then in the US, Chicago PMI came in at 44. And then ADP 113, and that was lower than expected. It was due to come in around about 150. So so jobs data was a little bit disappointing this week, but I think, get used to that. That's going to keep being just what's going to happen now. So then PMI manufacturing came in at 50. 50 is growth, so you can't complain at that. And then sort of the manufacturing employment index came in at 46.8. So again, that's sort of showing that maybe the jobs, there's going to be less jobs around, and maybe some people are going to start to lose their jobs as well. Then the ISM manufacturing PMI came in at 46.7. Again, a little bit of contraction there, but nothing major. I think it's in low 40s or below, then that's a concern. Service PMI came in at 51.8, which is again growth. So services are still doing quite well. Manufacturing still not so much, and that's down to consumer demand, and of course with these higher prices, you can understand it. Okay, so moving on, and then the jolts came in at 9.55 million, which was an actual increase. So there's still plenty of jobs around. It's just a matter of whether it's for the right people and they have the right credentials and qualifications to take those jobs, I guess. Okay, and then of course we move on to FOMC. They kept rates unchanged at 5.5%. Subtle warnings that they could do more if they need to, but it just seems as though they're done, especially when you look at the jobs data. But it's all data driven now, so maybe. And December will be an interesting one. But I guess at the moment most people would just expect it to be another unchanged. And then after that, so when we look at NFP, so let's look at the average weekly hours. That was down just slightly by 0.1 to 34.3. The NFP number was a surprise on the downside, 150,000 versus 180,000. And then on top of that, the So, yeah, I mean the earnings itself was down as well, at only 0.2% month on month, 4.1% year on year. So all of that's sort of quite positive, really. The dollar got hit, which is, it's good for the country, it's good for the economy potentially. Inflation's dropping. Okay, not so many jobs around, although there seems to be still, so it's a little bit contradictory there. But the dollar gets hit. So, it's not quite as full on for the dollar, but I don't think it deserves to sort of start to weaken because of the data coming out, because the data is actually economically positive for the moment. And then when we move on to the EU, so CPI harmonised, the core came in at 2.9%. And that was expected at 3.1%, so that was a little bit lower. And the overall core at 4.2%, which was sort of in line with expectations. GDP negative 0.1% quarter on quarter, 0.1% year on year. So not great there, and bordering on obviously recession. Then consumer confidence, that came in sort of expectations, negative 17.9. Then when we look at the services, services sentiment, that came in at 4.5, which was higher because it was only expected at 3.4. And the employment rate has crept up just a little bit to 6.5%. Then we move on to Germany. So retail sales, negative 0.8 month on month. That was expected to come in a positive 0.5, so that was a big miss there, and that leaves it negative 4.3% year on year. Then CPI came out month on month at just zero, so that gives it 3.8% year on year, and the harmonised is 3% year on year. And GDP, they sort of managed to just stay positive at 0.1% quarter on quarter, but that's still negative on the year by 0.3%. In Switzerland, PMI came out at 40.6, so that is contraction. CPI 1.7% though, so they've seem to have inflation much more under control. Australia retail sales came out, and they came in at 0.9%. They was only expected to come in at 0.3%, so that was a beat there, so that's good news for them. Okay, so then if we move on to the UK, so consumer credit 1.39 billion, practically in line to what was expected, but mortgages were lower at 43,000. Then net lending to individuals was 0.5 billion. Now, obviously we're looking at that sort of lending and borrowing and all that, so that the net lending overall was 5.2%. Now, that is important because, if people are using cards or credit of some form to borrow, and of course, with rates moving up, it becomes much more expensive, which reduces their disposable income, along obviously with all these really high prices for everything at the moment due to inflation. House prices dropped 3.3% year on year. I suppose that's not too bad considering the condition of the country and the government. PMI manufacturing came in at 44.8. That was lower than expected. It was due to come in at 45.2. The composite came in at 48.7, which was better than expected, and services were higher than expected. They came in at 49.5. So bordering on growth again there. And of course, the Bank of England made their rate decision and they left the rate unchanged. But the vote was 6-3. So again, some of them wanted another hike. Obviously, still concerned about what's going on with inflation. Inflation is struggling to come down any lower. Oil prices, when they go up as they have been, they did drop a bit this week, but when they do have those rallies, it makes sort of gasoline, heating, all the byproducts all more expensive, makes transport more expensive. So it does have that knock-on effect. Oil is one of those things that's impacted by the economy, but also impacts the economy. Okay, then looking at Japan, unemployment came in unchanged at 2.6%. Industrial production came in at 0.2% month on month. That was expected 2.5%. Bank of Japan left rates unchanged. They're the only country with negative rates now, negative 0.1% there. They did tweak the yield curve a little bit, but it wasn't enough to stop the yen coming under more pressure. Consumer confidence was higher though at 35.7, and PMI was higher at 48.7. In China, PMI, the manufacturing came in at 49.5. That was lower than expected, but again, it's still near 50, so it's not such a big deal. And non-manufacturing was 50.6, although that was lower than expected. It was expected to come in at 51.8. And the Caixin PMI was 49.5, which again was lower. It was due to come in at 50.8. And services came in at 50.4. In Canada, GDP is flat at 0. PMI manufacturing came in at 48.6. The unemployment rate crept up very slightly to 5.7%. And then finally, New Zealand. Employment came in at negative 0.2. It was expected positive at 0.4, so that was a miss on the downside. And the unemployment rate is 3.9%. So, I think you're starting to see those unemployment rates rather, just creeping up. And, that's going to be an important factor as we go along. And yeah, geopolitically, there's things to think about as well. But on the data side, we may sort of see the final impact of these rate rises hitting the economies very soon. And I think, because we're coming up to the festive season as well, when you look at this employment data, that's going to probably get a little bit distorted over the next couple of months just because of Christmas hiring, in the US Thanksgiving hiring possibly as well. So it may take till January or February before you start to see what the real employment picture is going to be like for 2024. Okay, so I hope you'll stay with us for part 2. So just moving on to highlight what we do as a company. Obviously, the majority of you are probably familiar with that, but there's always some new people viewing these. So it's just to give you a little bit of an insight into Symax Fintech as a company. So apart from the YouTube, we provide daily newsletters, which include sort of global headlines, global news, and then as an option there's fresh chart levels and pivot points each day. Then when it comes to sort of workshops, if people are looking to get into trading, then our sort of introduction to trading is a great one, trading for beginners. And then for others that are already trading but have got gaps in their knowledge or their trading skills, then we can help you with those as well. We do offer 1-week courses. They can make you feel competent and confident in just 1 week. Does it make you a trader? No, but does it give you the foundations on which to build your trading career? For sure. And if you've got that inner trader, I will find it. And of course, now you have the option of going for one of our new course, which actually includes a free trading challenge attempt as well.
And then if you're really serious about making trading your career, then our comprehensive accredited masterclass is the one for you. It's designed to provide you with all the knowledge and trading tools required to navigate any market conditions, and also any asset class. And the next one of those starts on the 19th of June. So you've got a week to register if you're interested. Then trader mentoring, some people don't want to go through courses, but they do need help still, and I can certainly do that. Consulting, we consult to companies around hedging, FX and commodity exposure. And then of course we provide a mass of educational content that can be to individuals, exchanges, to brokers. And as I just mentioned, if you're looking for that funded account, maybe you're a bit sort of undercapitalized, or possibly you just don't want to use your capital, then there's the opportunity to go through the challenge and hopefully qualify for a funded account through one of our partners, Nordic Funder. If you'd like to contact us, it's info@symaxfintech.com. Any questions you'd like to aim directly at me, it's chris.tubby at Symax Fintech. Sorry, go back to that one, christubby@symax-int.com. Just get so used to the fintech part. And of course, look forward to seeing you in the second part.